I hope everybody is doing safe and well. I wanted to take a look at crude oil and the markets, and then later get into some trades for this week. So, the first thing before we even get into crude oil, I'm going to look at the S&P 500 and take a larger view on it. So, on the weekly time frame, we go on to the weekly time frame, we're starting to see equilibrium pattern. And for those of you who are not very technical, or for those of you who are new to this or you don't know what an equilibrium pattern is, very simply, after you have a large move like this, you tend to retrace 50%, and then from there, you retrace another 50%, then you retrace 50%, until you get to the point where the range is so tight that it has no choice but to break out of it. As you see a tightening range, and then you can add trend line right there, and then a trend line right here, and then eventually does a breakout. And so that is the equilibrium pattern. And it could keep on tightening forever until the range becomes too tight. So from here, it could have 50% retracement back down, 50% up, but at some point, it becomes so tight that it won't keep on going. But we've seen these before. If we go into gold, XAU, USD, so gold against the dollar, we actually saw an equilibrium pattern earlier, about a couple of weeks ago on the daily. So you had this big move down, little over 50% retracement, and then a little less than 50% retracement down. But it starts to create this pattern where, in the perfect world, what would happen is that you would have a big down move or up move, 50% retracement, and then 50% retracement. And it keep on doing that again and again and again until the range was so tight that it has no choice but to break out of it. And that is really an equilibrium pattern right there. So, looking at SPX on the weekly time frame, I think it's very likely that we see this again. Those of you who have been on this channel long enough, you guys know I'm not a technician, and so this is not a very large part of what I do, but I still think that that we could possibly see a equilibrium pattern starting to play out right here. So, what would we see? What would we see right here? 50% retracement. I think this was a 50% retracement level, and then from here we probably would go lower and possibly have a small bounce for probably just less than a week, and then from there it breaks out either really bullish or really bearish, and I think it's more likely to break out bearish because of the fundamentals that we've been talking about for a long time. If you guys are wondering about what these fundamentals are, right here, very simply, this is the YouTube channel that we have, and we've made a lot of videos, I think, right here. US oil has headed lower, WTI analysis. We made those a month ago. Almost 2 months ago, we made Can the Market Go Lower from Here? Go and watch those videos. We talk about it in there. If the market can head lower, and also about oil, we've been very adamant on oil heading lower from here. And so go ahead, check those out. But we talk about it in there, why we would have more of a fundamental bearish viewpoint than a bullish viewpoint. And now the technicals are starting to play out with this equilibrium pattern where where it makes a 50% retracement. Then from that 50% retracement, it has a 50% retracement of the 50% retracement back down. And then if it can, it might have about half a week, so a couple of days where it makes a small bounce up. Then from there, you decide, due to the fundamentals, if it will break out bullish or bearish. So there's that right there. And I think this is a perfect time because it's setting up where you have earnings, and the earnings might be bearish coming into next week. We do have a large earnings over, like, I'd say last week, this week, next week. Those are big earnings weeks. So you have earnings season right here. So there's a big binary, lots of binary events right there. And then on top of earnings season, you also have oil going down. And so I'm going to look at the front month. And again, if you want to know more of the fundamentals, go look at the older videos. We made them a while back. Just look at the older videos. Clearly downtrend on the weekly. Going on to the daily. This was just a lower high right here. So you're looking at these green candles. They were just a lower high, makes absolutely no difference to us, but it still kept on going down. Lower high comes down again. Um, that's all there was to it, but still bearish on it, and still thinking that there could be deeper contango from here. And I think that this contract, the June contract, could quite possibly go negative. And yeah, that's just what we're looking for right here. Is that this contract's probably going to go negative, just like the May one did, and that we're going to see deeper contango is something we've been talking about for a long time. Again, as I said, go back to the videos a month or two ago where we would talk about how we're bearish on the markets, how we're bearish on oil, all those good things right there, and how the oil one we've especially been right on. Bonds, for the most part, we have been right on. Um, Markets, they are acting a bit irrational, but I think at some point it's going to have to stop. And I think that time might be now that I take a small downturn in this equilibrium pattern, and then before taking a small upturn, and then from there it's going to break out with this tightening range. So taking a look right there at crude. So the markets for the week ahead. We have earnings, got some global macro trades, bottom up trades, and then some previous trades. So earnings trades first off, we have Apple and Microsoft reporting. So how do I feel about those two? I'm looking at them on a relative basis. I am more bullish on Microsoft than on Apple, or I'm more bearish on Apple than I am on Microsoft. So I have a pairs trade right there put in. Apple, their business model, I think that first off is trading for very high multiple compared to what most in the industry should trade for. I know Microsoft is too, but Microsoft has a lot more growth priced in, which is good, because with Apple, there's so little growth. It's already a $1 trillion company, and so you don't have this large amount of growth as a company itself. Then the secular growth in the economy is also small. And remember that Apple makes most of its revenue when people go to the Apple Store from in-person purchases, whereas Microsoft does a lot of things online. They make a lot of their revenues from there. So Microsoft is affected, but not as much by what's happening in the supply chains right now and what's happening in the economy. Microsoft is not as impacted. And even though both of them are trading very expensive on a PE ratio basis, it's more justifiable, I think, to say that Microsoft should be trading at that PE, even though I think it's a high PE, than Apple trading at that high PE, because both their PEs are high, but at least Microsoft has some growth in there. But Apple has absolutely no growth. I don't see a reason as to why Apple should outperform Microsoft. And so right here, just looking for Microsoft to outperform Apple. Apple call vertical spreads, strikes and expiration. So I want to be long the May 1st, 2020, 300 call, and short the May 1st, 2020, 290 calls. And so it's a vertical call spread. And you could use that as part of the bearish part for what we want to do on Apple. Expected return 26.5% return on capital in 4 days. Obviously, that's a higher return on capital. Most people are going to make like 4% a year. Most investors don't even make 4% a year after inflation. But right here, that of course, so on the relative basis, everybody would try to put this trade on, but you have to realize that the probability of this trade succeeding is only about 65%, which is still very good for a 26.5% return on capital. But just keep that in mind. On the other side, on Microsoft, call horizontal spread, long call, and long call. So here's what I want to do. This one's going to be a ratio. So the strikes and expiration, I want to be long 2 180 October 2020 calls, and I want to be short 1 May 1st, 2020 190 call. This way you're not limiting your upside potential and the underlying can go as high as possible and you don't lose a penny. And expect to return 100% in 6 months. I would only keep this trade though going on for no more than probably 2 weeks. And I would usually pair it with the Apple trade on a notional value. And so the Apple trade costs $10 per share to go put on. And since options cover 100 shares, that's $1,000. Right here, this trade, it costs more so somewhere around $6,000 or so to put on. So I put on 6 of the Apple trades in one of these Microsoft trades, so you have the same notional value in both of them. And if you want to pair trade like that, if you just want to pair trade stock versus stock, you can also do that. That's what we were talking about right here. Apple, Microsoft pair trade. But I just think this is a better way, get a higher return on capital, positive theta, all these good things right there. Okay, so global macro trades. So earlier we were talking about the next 10 bagger, and we mentioned Euronav, and Euronav has gone up a good amount. Another one that we mentioned that's gone up even more. I had long calls in this, but I told you guys you can do some covered calls. I thought the calls were expensive, but then I just went ahead and I just owned the stock instead because I was willing to take on more risk. Covered calls, the main difference, with covered calls, and just owning the stock is that whenever you do a covered call, your risk for the most part is the same as you would own the stock. The amount you make is less, but the reason you do a covered call is your probabilities are higher. If I sell a Delta 30 call on the stock that I own, I'm now raising my probabilities maybe to 80% of making money rather than just having the old probabilities of 50%, which is what you get when you buy a stock. So just keep that in mind right there. But Nordic American Tankers, it has gone up a lot, clearly. We got in, let's see, somewhere around, I believe this was the day right here. But as you can see right here, we got in, and it's had this big up move. So I wouldn't want to get in anymore. Now it's already up in the pre-market, basically another $1. If you own the stock, it became like a 2-bagger. If you own the options, it became a 30-bagger. I did own the options at first. Here's what was going through my mind. So at first, I was saying, okay, if I want to limit the upside, I'll do the covered call. But if I care more about profitability rather than probability, then I'll just own the stock. But I looked at the calls at first because that's how I usually like to go about this. The calls were very, very expensive. This was just at the time, it was $3.80, and the expected move was $2. That's basically like expecting a stock like Apple to move $200 in one direction over the next 3 weeks. It was a crazy high expected move. And so at first I got into it and I said, okay, I'm just going to buy the stock. The calls are way, way, way too expensive. But then I bought the stock at $3.80. I released a video for you guys when it was at $4, but later in the day it came all the way down to $3.70. The market starts cyclical, so you could have gotten in lower than I even got in. But then it was down at that price, but then it went all the way to $5, and then finally when it got to $5, somewhere in the high 40s, I said, oh, the expected move, even though this is really, really high, this company is fairly levered, has a levered balance sheet. The expected move is high, but it's actually not high enough, and I think the calls might actually be undervalued. But if you did the covered call, you still would have been fine. You would just need to roll it up. But still, then I bought the calls somewhere in the higher 4s or lower $5 range. And it's going good so far. And I would have to say that I was hesitant at first for buying those calls because the expected move was so large. It would have to move, the expected move that was expected over the next 3 weeks, it was more like 4 weeks, but still, the expected move over the next 4 weeks from the time I had bought it was basically $2 for a stock that was $3.80 at the time. That basically means, you could multiply that by 100 and think about $380 stock. Apple used to be at $330, $340, and it would make, and that's like expecting a stock like that to make an almost $200 move to even break even on your calls and puts. And so the expected move for me, and doing that over just a 4-week period. So the expected move was so large. But then, so at first I said they were overpriced. That's why I said you could do a covered call and sell those calls. But then, and I plan on just owning the stock, and after it went up, selling the calls like in covered call. Lower probabilities, but higher profitability when you do that. But eventually came to a realization. I was like, oh, well, these calls are actually underpriced. This company has so much debt, and the balance sheet is so levered that this company could become a 10-bagger overnight. But it could also go bankrupt. So actually, the volatility is so underpriced. But I think people were thinking the same thing that I was thinking, and thinking that it was so overpriced, and they were trying to sell into that vol instead of buy into that vol. But then I later bought some calls, and so here we are today. It's already up almost $7 in the pre-market. So it's already gone up a lot. So I wouldn't head into this one. But there is another one. So this is Sakos Energy Navigation. Sakos Energy Navigation has not had the same move, but I think this one could actually outperform Nordic American Tankers. So if you missed that trade on Nordic American Tankers, you didn't buy it, you didn't do a covered call, you didn't buy the calls, you didn't, if you would have done the covered call, as I said, 15% return in just a month will end up being more like 15% return in a week. If you bought the stock, you basically double your money, 100% return in like a little over a week. And if you just bought calls, it basically would have been a 30 bagger. But if you missed that move, that's fine. We have Sakos Energy Navigation. You could, of course, just buy this thing, but I actually think that they are underpricing the volatility on this, and the implied volatility is underpriced relative to realized volatility on Sakos Energy Navigation because it's such a levered company. It has a market capitalization of just 300 million, but the amount of debt that this company has is almost 4 billion. And so debt, of course, is a double-edged sword. It can work against you, it can work for you. But if it works for you really, really well, and it basically just makes your returns, in this case, 20 times what they should be. Sakos Energy Navigation, I went to their website, looked at their vessels, looked at the rates for those vessels, and the crude oil tankers that they had. And later I went on and looked at their balance sheet and things like that. And I basically came to the conclusion that they could easily be making $5 million easily in the current market environment. Even if things stay as is, they can make $5 million and every day. So $5 million every single day. That's basically making almost $2 billion in a year. And that's just if things stay as is. I think they're going to get worse. So this company is only worth $300 million. It's going to make $2 billion in a year. So that can work with you because this is a double-edged sword, and one side of it does work with you if things go in your way. So this thing, the stock itself could become a 10-bagger, but I think the options trade that we're looking for right here, that I have right here, Global Macro Trade, we have TNP, long haul, strike, and expiration. So I want to be long the June 19th 5 call. Expected return 2,000% return on capital in 6 weeks. So we're expecting a return of 2,000% in 6 weeks. This is obviously a riskier trade. You're expecting high return on capital, but there's higher risk to it simultaneously. So put as much as you want to risk. If you want to have less risk, just buy the stock. That's a lot less riskier. Do a covered call on it. But if you're willing to take the risk, buy those long calls right there. 2,000% return on capital. That's going to be expected. And again, this is one of those trades where the likely chance the chance that this lands in the money and that you make money is only about 30%. But if you do make money and it's that 30% of the time, you're going to make a lot. But of course, risk what you can for this. So we have bottom-up trades. So Zoom and Facebook. So basically, you can just search up Zoom stock. And so you just search up Zoom stock, and what you're going to notice is that in the middle of the day at 2:15, you had this ginormous drop. And then you can also search up Facebook stock, and at the same time, you had a big rise. So what happened? Zoom is expected to make a lot because of all the revenue that they're going to be making from this new streaming service and everybody going online and doing everything online. Here's the thing though. Facebook came out and said we're going to compete with them and we're going to make it better than them. And I have no doubt that Facebook's going to be able to do that, seeing the type of company they are, seeing that they are, a 600 billion almost company. They have the resources to outperform Zoom. And the only reason Zoom stock went up, if we look at this, the only reason Zoom stock went up is because of the coronavirus. Down here from its bottom at $62, it consistently just went up because everybody said because of the coronavirus, everybody's going to be using Zoom. But now, if Facebook starts competing, people start using Facebook's application instead of Zoom, then Zoom's whole business model is just gone. And Zoom is a single business model company. And on top of that, you have a PE ratio of almost 2,000. It's unjustifiable. So I would want to be short, fading into these rallies over here on Zoom, and Zoom just kept on rallying higher, as I said, up 153 percent, over 153% from the trough that it used to have back December 2019. If we look at Facebook instead over the last 6 months, it has gone up since October, but it's had a big drop from $223, and now because of this, it might quite possibly have another revenue stream that Zoom used to have, and to steal the revenue stream from them. And Zoom is essentially worth almost $100 billion now. If things keep on going the way the stock was rising, now it's, it was worth $50 billion as last I checked. It started to go down because people are trying to get onto this. But if it actually kept on going up at the rate that it was going up, I felt that this could have actually turned into a company that was worth $100 billion. So just right there, I just don't see the justification for this sort of evaluation for Zoom. So short Zoom, long Facebook. Expected return 15% return on capital in 1 month. This is obviously lower risk, lower reward, I would say, and lower volatility. And then looking at previous trades, as I said, we had a NAT covered call, EURN long calls. So NAT covered call, just sell it, roll it up in strikes, and then EURN long calls. As soon as those become in the money, you just roll those up to the next strike, and if it's getting really close to expiration, rolled up to next expiration. So roll these up and over. Other than that, the market is up in the pre-market. As I'm recording this, it is currently at, as I'm speaking, 8:50 a.m. But here's the thing. Oil went down. We're looking for that equilibrium, so we're looking for the market to go down this week, because I think there's an equilibrium on the weekly chart for the S&P 500. So I am looking for the market to go down this week, and also oil is down. That's going to probably push the market down. I think the market's acting too irrational right now. What we do see, though, is that in the pre-market, S&P 500 is up about 0.94%, and then Nasdaq's up a bit more. DJIA, so Dow Industrials, not as much. So these were actually up a lot more. These were up, I believe, more than 3%. And also IWM, the Russell 2000 Index Fund, is up 1.67% pre-market. And transports index fund is flat, but these were up a lot more. But oil quickly went down. If we actually look at CLM 2020 front month oil, go out and just look at the hourly, just in the time that I woke up and I started recording this earlier, I started looking at this earlier, it's already gone down a lot and it started to pull on the market. So the market is clearly sensitive to this. And just in the time that we were recording this, it's gone down. I'd say, we've been recording this for quite a good amount of time, but it was up here before, closer to $13.50, and now it's already down even farther. So look out for that right there, because I think that the market will go down this week. It's going to go through an equilibrium pattern, but just watch out for that right there. And oil futures clearly pulling down on the market. Pre-market futures were up over 3%. Now they're up less than 1%. I think at open it could be flat, and we could see on the open, we could see some bearishness until midday, and then midday we probably could see a bit of a pullback, but then it sells into strength and it goes lower. But of course, I'm not technical. I don't trade intraday, short term, or that, at least that short term. But just keep that in mind. That's something to keep in mind right there. But I am expecting the market to go lower this week. So again, here are the trades: earnings trades, global macro trade, bottom up trades, previous trades. Of course, take a look at those. Go through the video again if you need. If you have any questions or anything of that, go ahead and ask me inside the comments section. I'll be there to answer any questions you may have. Other than that, I try to make a video basically every day that the market's open. I'm making a video. So if you want more of these videos, go ahead. Just subscribe and turn on your notifications, because we are here every day that the market is open and we answer all your questions. So if you're a new trader and you have many questions about what in the world we're talking about, we're there to answer them. Other than that, thank you for watching, and happy trading.